The federal government has proposed a budget of 47.9 trillion naira in 2025. Budget represents a 36.6% increase relative to 2024 budget, plus the supplementary budget. Interestingly, the budget deficit is expected to increase by 42% to 13.08 trillion from 9.18 trillion in 2024. The last 30 years, Nigeria has achieved a budget surplus only twice: 1 billion in 1995, 36 billion naira in 1996, and a budget deficit for the rest of the period. Kenyanese economists believe that when the economic engine sputters, a fiscal deficit of increased government spending can act like fuel injections, revving demand and production through the multiplier effect. Despite perpetual deficits, Nigeria has seen limited capital expenditure, private investment, or accelerated economic growth increases. Nigeria budget deficit have only translated into heavy reliance on ways and means advances, which has increased inflation and pushed the country towards unsustainable debt level. Let's talk to Professor Ken Ife. He's a global economic consultant, entrepreneur, and keynote speaker whom for over 30 years has spoken in over 40 countries and delivered strategic programs within engineering, technical services, enterprise development, and public policy. Prof, good afternoon and thank you for being on the program. Prof, good afternoon and thank you for joining the program.
Well,
all right, Prof, if you can hear me, I'd like you to react first to this planned spending plan for the year 2025, 47.9 trillion naira. The assumptions of this amount, what do you make of it? How conservative has government been and how realizable is this spending plan? Good afternoon, Prof.
Hi, good afternoon.
So can you hear me?
Yeah, I can hear you.
All right, I was asking you about the planned 2025 spending plan of 47.9 trillion naira. How does it come to you?
Well, moving from around 28, 27 to 48 is almost a 100% increase. But I've always thought that 50 trillion is the kind of figure of a budget that is, on average, seems reasonable for Nigeria. That's quantum. But I'm not too sure about the fundamental assumptions of the fiscal strategy paper that is really underpinning. I like the size of the budget. It's more realistic. That's what we need. But I'm less confident about the macroeconomic projections that are the bedrock of the fiscal strategy paper. And if you look at the forecast of crude oil at 2.2 million barrels a day, I know we are going near 1.7, 1.2. Let's hope we'll get there. But that's not what worries me. What worries me is the benchmark of $75 when crude is selling at 73, and when all the signs, I mean, the International Energy Agency, they all predict that it might go around a lot higher, 1.8 or something, 82, 83. But it will come down because Donald Trump has won the election, and this man and his drill baby drill will definitely, in his period of 4 years, oil prices were down. He believes in pumping out crude. Even shale oil, he wants to drill. So that means that we might have a much lower price range in the period than we have anticipated. So you cannot run away with a $1.75 $75 budget. I think we should come down to about 70 or 71. There must be a headroom. We must have a reasonable headroom so that we can have accretion to reserves, where we have such a serious financial pressure, especially on the forex side, that we don't want to push central bank to start releasing the current foreign reserve that is just above 40 billion to begin to bring it in to service debt. We should just allow a headroom to allow some accretion to the reserve. And oil prices are likely still going to erupt in the Middle East, so we can't So there's going to be a slump in the price, and there's going to be a reduction in the production allocations from OPEC, without a doubt, in this regime of Trump. Then there are other ones as well that worry me a bit. You know, we have a projection that we need $2.2 billion external borrowing, but that's not going to be enough. Let me explain. We've already borrowed $3.58 billion to service debt in 9 months, the first 9 months, $3.58 billion. Compared to this corresponding period in 2023, it is actually 39% higher than it was in 2023. And obviously, we are going for 2.2 billion, which is much less than that 3.58 billion. And what worries me about that 2.2 is that you're actually using 800 naira to $1 to compute that, to give you 1.76 trillion. That's not going to fly, because you are on the benchmark, you have $1,400 naira to $1. And the market rate today is 1,640 something. So we are punching below even 50% of what is the actual going rate in the marketplace. So if you are using 800 to compute this to 1.7, what it tells me is this. Your computation of, we have these 2 guidelines in debt borrowing. 3 things actually. You have debt servicing to GDP, to revenue, government revenue. You have debt servicing to fiscal deficit to GDP, which the law says, FRA 2006 says 3%, but now you're raising it to 4%. But if you use the appropriate rate, let it even be 1,400 naira, to multiply that 2.2, it will be over 3 trillion. So how that now measures up on your deficit means that your deficit is going to be a lot higher. And they might be higher than what the law says. So I worry about those. And of course, the debt to GDP ratio is already crossed the threshold of over 50%. So we don't want to throw caution to the wind. And I'm maybe uncomfortable with many of those parameters.
Question. We're supposed to save from subsidy removal, and Nigerians are expecting what government will do with all of these funds. With what we have at the moment, how do we start to, or how do you think that we start to move away, talking about the reforms now that the country is going through? When are Nigerians likely to see the positives of the savings from subsidy removal? This remains very important, particularly now that we are paying over 1,000 naira for a liter of fuel. I would ask you again that, do you think that we are outrightly, totally out of subsidy regime? Some say that PMS should sell for as much as 1,500 naira if we are away from subsidy.
Well, I think about 1,200 if we zero out a strategy, subsidy. But the fact is that there is some savings by taking it off, and however it is computed, but at least the actual volume we consume, Dangote says, is between 30 and 35 million barrels a day. So let's hope that is the case. But that is not where my greatest worry comes from. My greatest worry comes from the fact that we have substantial forex borrowing, and we have to service those debts in dollars. And I've only just given you the figure of $3.58 billion that will require in the first 9 months to service. So we're going to need more than 2.2 billion anyway going forward. But what worries me is, where are we getting the replenishment of the dollar to service the debt? The balance between Euro bond of $1.5 billion, and then you have the Sukuk bond, sovereign Sukuk bond of 500 million. I think it should actually be the other way around. We should be taking more Sukuk bond, sovereign Sukuk, than the Euro bond. Euro bond is very expensive. If it's coming in at 7-8% or more, it's very expensive in dollar terms. But if you go for bilateral loans, the reason why I like the Sukuk, sovereign Sukuk, is because it's project tied. You can actually see which project that money is tied to. And then if you go for multilateral and bilateral, multilateral, like World Bank, and then IMF and the Africa Development Bank, all those can actually give you money at 0.5% for 30 years, or for a moratorium of 1 or 2 years. And the Fiscal Responsibility Act says long-term borrowing at concessionary rates, which is less than 3%, and cost-benefit analysis, which the administration says immediately that they were going to focus on that. I'm not seeing much of that right now with what we are doing right now. And then it says for capital expenditure of human resource development. And human resource development we know to be health, to be education, to be employment. It doesn't include poverty reduction. It doesn't include sharing money with anybody. It is just about running projects. But we want to tie these projects to the loans. And I'd rather have the Chinese loan at concessionary rates, where we know that they are for specific projects, and even if they are tied loan, then fine, because you know that they are using it to fund particular contractors, EPC contractors doing certain stuff. So that is even easier, and it's a longer term kind of loan. So we don't have to now end up borrowing more expensive dollar to service dollar that is already out there, and then eventually that debt becomes deeper and deeper. We'll go deeper and deeper into currency debt with fluctuations in our currency, and devaluation going on. Is a very, very dangerous place to be. That's the one that worries me the most.
Now, Professor Ken, if inflation now stands at 33.88%, and we see all that the Apex Bank is doing to try to defend the Naira, if that's the way, if I'm right to put it that way, what's been happening in the FX market, and a bit of, there's still that disparity from the E&P, but at least we're still a bit flexible. But what do you think, or how long do you think we would stay at this point, talking about the FX? And are there quick wins for the Apex Bank looking at their efforts at this moment?
No, the central bank is doing extremely well, to be honest with you, believe it or not, because the greatest challenge we have in the Forex regime is, remember that Forex is price, just as inflation and MPR rates and all these lending rates, all of them are price. And so you have to have a demand and supply perspective around those. So CBN has focused on supply of Forex and has done so many creative things around that. Remember that there was a time it placed a ban on the commercial banks, their net open position, not even more than 20%. So they had to start selling some of their excessive stock of dollars to the market to lower that. So they did that. They also they're encouraging diaspora remittance is increasing. They also gone on inflation targeting, which was necessary because of the spread between the inflation and then the exchange rates and the monetary policy rates. The spread is too much, and that's why we're in negative real interest. So, and it's one of the ECOWAS macroeconomic conditions, a macroeconomic convergence criteria, that we have to have a positive real interest rate. So if your inflation is at 33 and your MPR rate is at 26, you still have a big gap there. So the tendency is to continue to go up until such a time, either you have an inflection with the inflation coming down, or you will see whether other market conditions allow you, and economic conditions allow you to hold the rates and start coming down. But some of the conditions are being met. One, investors actually want to see you take out that arbitrage between the two rates. That is the government rate and the unofficial rate. That has closed. And what that closes is, it says to the market, I know what you do. You collect the facts today, and tomorrow you buy dollars and you stack up dollarization of our economy, but you're not going to make money from that dollar. So we're going to have to make sure you don't make money. And then so that happens is that it is now encouraging inflow of Forex foreign portfolio investment is coming in. Some of them up to 100%, over 100%, to 1,000% coming in. But when it comes in, I know it will still go back within a year or so. But at the moment that it is coming in, it is helping to stabilize the dollar in the marketplace. So while that is going on, CBN is quietly having accretion to our reserves from the Forex coming in, from crude sales and gas sales. So it's accreting to reserve for the rainy day. And that rainy day could come when Donald Trump goes off guard. If he goes off guard and starts pushing the rates and then start pushing the crude and all of that, we're going to see if the rates go up in America, some of this portfolio investment will go away because they want to go to a stable currency where America will never pay their debt anyway. They will be giving, but it's 100% guaranteed. So, but they will never pay it because they will print more dollars. But then they are still happy to go back. So what is it is that, so our forex will continue to build at the foreign reserve end, preparing for the rainy day when these people are asking for their money back. And of course, the FDI will not help you because only 29 million that we got 29 million, would you believe? So you can't put hope on FDI, but that's where remittance is coming up, as long as we can do more. So I think we need to take more diaspora bonds, take more multilateral development finance, more bilateral finance, and then other creative financial mechanisms to ensure even more on the debt-based financing, which we know. We started securitizing last year. We started securitizing some of our crude revenues and securitizing some of our gas revenue. Of course, we have to stop that crude one because Dangote is upstream now. He needs the crude, so he can't go ahead and securitize it anymore. But we still have to live with the fact that we already committed 5 years. So all of those stuff, but there are assets of government that we need to push out, either by via of privatization or commercialization or whatever. They've got thousands of assets of government that we need to push into this debt-based finance, and then they get NAPC out there into the capital market to raise.
All right, Prof, let's wrap up this conversation. And what I'd like us to wrap up with is we are aware of the next Monetary Policy Committee meeting, a very important meeting that, investors and everyone waits for. Whatever decision is taken at that meeting shapes the idea of investors and sort of investments we should expect. So what do you think will top discussions around that table when that meeting will hold, I think, sometime next week? What are your expectations? Professor Kenife, can you hear me? Wow, I guess. All right. Okay, Prof, can you hear me now?
I can hear you.
All right. Did you get my question?
Yes, I can hear you. Yes, you said what should be in the minds of the monetary authorities when they discuss the next meeting.
Great.
I'm saying that they'll be looking at some parameters.
Go ahead.
Hello?
Go ahead. You're live.
Yeah, they'll be looking at the inflation parameters, particularly the food sub-basket index, and then they will also be looking at general prices in the economy. They will be looking at what the budget portends, especially what the borrowing requirements are going to be, because those are going to be, market, and then also the liquidity situation, which of course, this morning you saw that the portfolio, not portfolio investment, the yield on the sovereign bond yields is going at about 23.5%. So that domestic
all right, then I must thank Professor Ken Ife there. Thank you so very much. I was able to make sense of your submission on the last question. Thank you so much.